Welcome to our today's session, where we're still on the issue of transfer pricing. This is after appreciated what transfer pricing is. We have seen the characteristics of a good transfer price. For example, they should look at the entire multinational corporations goal, that is goal congruence. We have also seen and appreciated that the transfer pricing, the system used in transfer pricing, should help the divisions to be autonomous, isn't it? That it motivates the managers. We, having appreciated that, we have also seen the various systems of transfer pricing. One is the market price approach or the cost-based approach. We have seen that the market price approach is used when the markets are functioning efficiently. However, when markets are not functioning efficiently, then a multinational corporation can go for the cost-based approach. We have seen in a cost-based approach, there is a push and pull between the supplying division and the receiving division. We have seen an intermediary, which we call the dual pricing. From that also, we have appreciated that there are some adjustments that need to be made at the market price, and there are some adjustments in terms of cost. The standard costs, we have seen the marginal costs, and we have seen the element of opportunity cost. Having seen that and having appreciated those concepts, we are moving on to the calculation bit. So international transfer pricing in respect to taxation and dividends. You will agree with me that one of the factors or the considerations for a good transfer price is that it should lead to a minimal tax effect across the globe for the countries where the multinational corporation operates in. So we have seen that the costs of one company or one division or one department is being passed to being the costs of another company or the receiving division. That costs, especially for raw materials, will form as a revenue bit to the sending or selling department or division, which will form as a costs of operation to the other company, which we are saying is a receiving what? Division. This has two effects. It will impact on the taxes that are going to be paid, number one, and it will impact on the dividends that are available to be distributed to what? The shareholders. The dividends to be distributed to shareholders are based on earnings. So anything touching on earnings will also touch on the taxes, because you have to distribute your earnings after what? Available for the earnings available for distribution to shareholders. And these earnings available to the shareholders, they are from the revenues of the company and the costs of the company. So we are saying, in respect to taxation, the selling and the buying divisions will be based in different countries. Different taxation rates and policies allow the manipulation of what? Profit from the use of the transfer price. Let us look at an example which were given over here. It states as follows. KBP Coffee is a multinational corporation. Division A is based in Vogtland with a tax rate of 50%. This division transfers goods to Division B. Division B is based in Titoland, a country with a tax rate of 20%. Based on a transfer price of pounds 50,000, the profit of the divisions of the company is as follows. So we are saying here with an illustration, so we have division here and we have the pounds, division B, and the pounds. Then we have the company's position, which is the total position, aggregate position. So we are saying the external sales here $100,000. We have 120,000, and then we have the total 220,000. We have internal sales transfers to B, so 50,000. So division A is the one that is producing. Division A is also the one that is selling to division B. So this does not sell. So the total transfer will be a receipt of 50,000 for the whole group. Then we have fixed and variable costs. Fixed and variable costs. And then we have 40. So total for the company will be 110. So one other cost is transfers from A. So it will not be a cost there, but it is a cost to the receiving division. So total to the company is 50 what? Thousand. You will appreciate that in the adjustment of the transfer price, a receipt and an exit of the same equal value has no what? Impact on the reported position of what? The company in the consolidated financial statements. So we have eliminated the intergroup what? Activity. So profit before tax so for this is 100,000 plus 50,000 minus 70,000 to give me 80,000. The other one I'm saying 120,000 minus 40,000 minus 50,000 to give me 30,000. So therefore we can say that the profit before tax for the entire group is 30,000 plus 80,000, which will give me 110,000. So we can say tax Division A, the question tells us, Division A is based in Votland with a tax rate of 50%. So the tax rate in Division A is 50% and goes, this division transfer goes to Division B. Division B is based in Titoland, a country with a tax rate of 20%. So this has a tax rate of 20%. And that, therefore, we can get the tax in pounds value. So we say 80 times 50% is 40,000. Yeah, so we have the profit after tax, 40,000 total for Division A. So what is 20% of 30,000? This is 6,000. So 30,000 minus the 6,000, we are left with 24,000 as a profit after tax. So 24,000 plus the 40,000 will give us what? The net position for the whole company profit after tax will be 64,000. So then it leaves us with a tax position total for the company with 40,000 plus 6,000, which will give us 46,000. Yeah. Therefore, we can say that this is the position of what? The company with what? A transfer, a tax, an international transfer pricing of 50,000 pounds. KBP Coffee wants to take advantage of the different tax rates in Votland and Titoland and decided to reduce the transfer price from pounds 50,000 to what? 20,000 pounds. What effect will it have what? On the books of the company. So we do the same exercise here again and say division A, and the figures are in pounds, division B, and the figures are in pounds, and then the company's position, the figures are in pounds. So external sales remain the same. The first is 100,000 plus 120,000 gives us 220. Internal sales transfers to be so 20,000 none at all, 20 to the group. Then we have fixed and variable cost remaining the same. Of 70,000 and 40,000. Total to the group is 110,000. So we are also saying that transfer cost from A nothing then we have 20,000, and then 20. So what is our profit before tax? What is our taxation? And what is our profit after tax? So profit before tax of division A will be 100,000 plus 20,000 minus 70,000 gives us 50,000. What is the profit to the division B? 120,000 minus 40,000 minus 20,000 gives me 60,000. This still gives me the profit before tax to the company of 110,000. Is 50,000 plus 60,000, 110,000. So what is our tax? The tax policy in Voteland is still 50%, and in Titoland is still 20%. So 50% of 50,000 is 25,000. Our profit after tax to be 50 minus 25 is 25,000. Sorry, 25,000. So our 60 times 20% is 12,000. And our profit after tax will be 60,000 minus the 12,000, which gives me 48,000. Our total tax exposure to the whole group will be 25,000 plus 12,000, that is 37,000. Therefore, my profit after tax for the entire group will be 110,000 minus 37,000, which will give me 73,000. So, what analysis do we make therefrom? We conclude and see that the effect of reducing the transfer price from £50,000 to £20,000, one, it increases the it reduces the profit of division A, where the tax rate is high, from 80,000 to 50,000, meaning there is the profit available for taxation in the high tax regime country. Tax rate regime will be lower, and they have transferred the profits from £30,000 to £60,000 to the jurisdiction that has what? A lower tax rate. In essence, therefore, it means as a whole company, the profit after tax has increased from 64,000 to 73,000. That is what? The effect of transfer pricing in respect to taxation. We also therefore know profit after tax is the one that is available for distribution as what? Dividends. So therefore we say also the transfer price what? Magnifies what? The dividends payable. However, in our past session, in the ones that looking at dividend policy for multinationals, we also looked at the issues what? affecting remittances. We came to the recognition of the fact that there is an issue of remittance controls. So a country's government may impose restrictions on the transfer of profits from the domestic subsidiaries to the foreign multinationals, known as the block on remittance of dividends, which limits the payment of dividends to what? The parent company shareholders. Often this is done through the control of exchange rate. So also we should note carefully that many tax authorities have the power to alter what? To alter the transfer price and can treat the transaction as having taken what? At arm's length, and therefore will adjust what? The profit accordingly. This now brings us to the end of transfer pricing. From the introduction bit of it, where we saw what? The characteristics of a good transfer price and the methods. We have also come to appreciate that transfer price has an impact on the taxation. One, it can be manipulated so that profits can be transferred from the regions that they are with high tax rate to the regions that they are of low tax rate, thereby increasing the what? Earnings available to what? To the shareholders. We have also come to recognize and appreciate the fact that many host country government tax practitioners can treat the element concerning transfer prices as if they have what? Taken place at arm's length, and therefore what? Make adjustments to the profits accordingly. We have also appreciated that the government in many jurisdictions across the country, many countries, do restrict what? The remittance of funds from subsidiary to what? The holding companies. In so doing, they do what? Through exchange rate controls. Thank you for attending our session. Our next session will be on international debt, and we will look at the issue of Eurobonds, commercial papers, and the like. Thanks.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.